And as we jump into this next session, I want to say a big thanks to Travelers and SGI for sponsoring this upcoming session. And without kind of further ado, we're going to make sure that we, without further ado, I'd like to introduce Joel Baker of MSA Research. MSA is a Canadian-owned and operated research firm dedicated to providing comprehensive research to insurance professionals. So today we're going to kick it over to Joel to give us an unparalleled look at what's going on in the Canadian broker and insurance channel. So kick it on over to you, Joel.
Thanks, Thomas. Pleasure to be here, and I'm sure if you invited me, I jumped at the opportunity. I wasn't sure I was able to do this, but I'm glad I made the time and I'm available. I'm sorry I missed the sessions this morning, so if I repeat something that was said earlier, please forgive me. So the session today, hopefully everybody can see the screen. We're going to talk about the industry in a dangerous time. We are in a very atypical period, as we all know, and I'm just going to go through the issues confronting our sector. First of all, an introduction of what MSA is. So MSA is a financial analysis firm that I founded way back in 2004. Before that, I ran AM Best in Canada. Before that, I ran a company called Track, which was a rating agency in Canada back in the 90s. So I've been in this game for almost 30 years, analyzing insurance companies and the solvency and the performance of insurance companies. Our clients include all of these sectors across the food chain of the insurance industry: insurers, reinsurers, brokers, reinsurance brokers, government, audit firms, everybody. So if you don't have access to MSA and you're interested, please reach out to me. MSA's main product is the Researcher platform, which is an online platform that provides access to the financial data of the carriers and a very powerful analysis tool to benchmark, analyze, do M&A analysis, performance analysis, and so on. We also have quarterly reports that we put out on the market every quarter, and the Q2 2021 report will be out later this week. And some of the data I'll present today is kind of drawn from the Q2 report and from the Q2 data that was released in late August by us. MSA also runs several conferences, including the three that you see here. So CataQ is a company that I founded in 2014 and actually sold in 2019, but I still run it in Canada. And we have a quarterly webinar through CataQ. The next one is called Cyber and the Connected World, and that is going to happen on October 14th. InsurTech North is a InsurTech conference, which will run next spring. And NICC, which hopefully many of you know about, National Insurance Conference of Canada, will hopefully be back, touch wood, COVID willing, we'll be back live in Halifax, September 18 to 20. So now I'm going to go through these topics. So the best of times, worst of times, COVID waves. The first half of 2021, the industry had phenomenal results. Cat information on the cats in Canada. I'll end on distribution and technology, and then we'll have a Q&A. So if you look at the situation we're in right now, I think this picture says it all. We're trying to return to normal in abnormal times. And this is an analogy that we can carry on to the industry. So it's really the best of times, worst of times. And we are trying to muddle through. So the good news is that the industry had solid results in 2020 and 2021 so far. There's been an acceleration of tech adoption, and the rebates and refunds kept the heat off the industry from the regulators and the policymakers. And the vaccines kind of hopefully will guide us into the recovery. On the negative side, we're still in a brutal hard market. Economic contraction and dislocation is still happening. Consolidation in the broker world as well as in the carrier space does limit the markets and constrain the flexibility. The BI class actions, we'll see where those go on COVID. And cats, did take a break in the first half of the year, but they came back with a roar starting in June 30th with the fires in BC and so on, and then it's been ongoing ever since. Then we have the still have difficult cyber and professional liability and D&O markets, and then we have the normal issues of the variants and the outbreaks. So back in March of 2020, we put this cartoon out, jokingly, not really serious, but saying that basically COVID will trump hurricanes and earthquakes with $10 trillion. And we weren't far off the mark because in March 2021, a year later, S&P came out with an estimate of 10.9 trillion on COVID. And then there were some parties that will, I think the IMF or others came out with bigger numbers of 16 trillion. So it's the biggest financial hit to the world, basically, bigger than World War II. So the governments have been spending like there's no tomorrow. The North American economies were kept afloat by unprecedented government spending and low interest rates. Underlying economic damage will be revealed once the anesthetic wears off. And managing the debt overhang and keeping inflation and interest rates in check will be tricky going into 2022-23. Higher inflation and interest rates are double-edged swords for the insurers. Rapidly rising rates are hazardous for the industry and the economy as a whole, as is inflation. And we talk about inflation in our next quarterly report, the risk to the market. So now I'm going to go into the COVID waves, the short section here, just talking about the growth in Q1 and Q2 was slow. We've got the fourth wave happening. The economy shrank in Q1 and Q2. So in Q1 and Q2 and in July, I guess that's when it happened. So we haven't got to Q3 yet, but we're in Q3 now. The government subsidies ending on October 23rd, right after the election. I guess they wanted to get that election done before they cancel that, if they are going to cancel that. And then basically the drip bag will be empty if the subsidies stop. And the question is, will the Canadian economy have escape velocity by then? Will it be able to sustain itself without the government infusions? So now we're going to go into our industry. So Q1 was outstanding for the industry. First half of the year was outstanding with 81.1 combined ratio and net income of 5.5 billion. This was because of a huge drop-off in claims and a hard market, both coinciding at the same time. If you compare the first half of 2021 to the whole year of 2020, or the whole year of 2019, or the whole year of 2018, you can see how big it was. So why so good? Well, direct written premium were up almost 12%, 3 years in a row of hard market. We had tame property, auto, and liability losses, so it was a quiet cat season in the first half of the year. Stable capital markets and investment income. The cats hit us in Q3. If we look at commercial carriers, you can see the net loss ratio dropped by 25 points. Really a huge drop off. Expense ratio tapered a little bit due to the hard market, so the premium base was larger over the expense hit was smaller relative to the premium base. And the combined ratio went down to 79.3. If you look at Lloyd's grew phenomenally in the first half of 2021. It saw a drop of claims, a 25 points drop in claims on the loss ratio, and a small reduction in expenses. resulting in a combined ratio of 79.3. And then personal multi-line carriers saw a lower, the hardening in personal lines is slowing down a bit, but the claims drop off happened in auto and property, causing the combined ratio to end up at 84.3. Reinsurers too had a very good first half of the year with the low cats and more volume through the harder rates. So they saw the loss ratio drop by 37 points and combined ratio down to 78.5 from 117.15 back in the middle of last year. So it's amazing results for the industry. And to put it into perspective, 93% of the carriers had combined ratios of less than 95 in first half of 2021. Compare that to only 50% is also very good. 50% in 2020 and 22% in 2019 had that kind of combined ratio. More than half of the carriers, when measured on premium volume, had combined ratios less than 85. And only 6.6% of the industry had a combined ratio higher than 95 in the first half of 2021, compared to 78% in 2019. So the tide may be high, but we're not really moving on yet. The hard market will persist despite the profitability into 2022, we believe. The reasons are the global reinsurance industry remains disciplined with the cats they had in Europe and the US and COVID as well. The rise of climate change with secondary perils. So the traditional perils that the global reinsurance industry was worried about are wind-driven events like hurricanes or earthquakes. The secondary events, what they call secondary events, are flooding and fire, wildfire. Didn't really move the needle for them until now. And these secondary perils are becoming primary perils in the climate change world we're in now. And then you have inflationary worries and historical rate inadequacy at the reinsurance level. The local Canadian dynamics, the argument could be made that the first half of 2020 is an aberration. The results in the second half will not be as great, not be as stellar. You have almost $1 billion of cats since July 1 in Canada. We have consolidation and home office pressure from abroad on the companies to hold the line on rate and not let the hard market slip away. And the Canadian hard market was performance driven, not capital driven. So nobody wants to go back to the cutthroat. Well, most people don't want to go back to the cutthroat rate inadequacy that existed before the hard market, where losses were eroding capital. The political pressure and regulatory pressure on insurers remains under control. There's stronger awareness of climate change. The insurers are wary of inflation, and reinsurance is not as plentiful as it used to be. And the accelerated adoption of technology and sophistication of the carriers may prevent reckless market share wars. And the last argument I can make here is that the fact that Economical is going public with Definity and Intact buying RSA, the larger companies have more at stake in terms of holding the line on discipline. So the industry is emerging from the pandemic different than it was going into the pandemic. So areas of strength, the industry has strengthened its financial position and its capital buffer. Capital is now 62 billion, up from 54 billion at the end of June 2020, so up substantially due to the profitability. Pricing discipline is still there. And hopefully you agree, I hope it's the case, that the quoting and renewal placement process is more orderly now than it was in the middle of COVID back a year ago. Areas of risk, cat risk is always there. Supply chain risk is there, and that impacts the cost of claims, also impacts the economy. Some lines are still very troubled. Auto may go back to its normal loss-producing self back in the second half of 2021 or in 2022. And you never can count politicians and regulators out in terms of calling out rate increases. And then the financial markets could teeter. And then there's COVID class actions. So what will happen when the supports are withdrawn? Inflation risk, maybe I'm repeating myself. And IFRS 17 is another risk. It's a new accounting standard coming into play in 2023 with a whole new different language and change of the metrics that the industry measures itself by. And that could throw a wrench into performance. And then the Liberals are threatening to tax insurers and banks with excess profitability. This won't affect that many P&C carriers. It mostly will hit the life cos and the banks, but one or two of the biggest carriers in P&C carriers in Canada may get trapped by this. And the hard market could lose steam amid pressure from the consumers, the businesses, and the regulators, and competition. So the next section, I'm going to take a break for a sip of water, but the next section is cats. So Canada is cat country. So Cat IQ is a company, like I said, I formed in 2014, and it was sold to Perils, a European industry body, in 2019. And we actually closed the deal on the day of the Raptors win, which was very exciting. But anyway, so Cat IQ is Canada's insurance loss and exposure index provider. We are supported by an overwhelming majority of the insurance and reinsurance industries, guided by an independent advisory committee. And Cat IQ and Perils loss indices can be used in risk transfer, such as cat bonds and ILWs. So we're going to do a recap of 2020 and then go into 2021. So summary of 2020. The year started off very wet with 3 flood events from January through April. Ontario and Quebec, a month worth of rain in 1.5 days. BC, Lower Mainland and Vancouver Island, and Fort McMurray, a 100-year event, as stated by Alberta officials. Traditional cat season then came in with a bang on June 13 when Calgary was pelted with massive hail and resulted in Canada's costliest hail event on record. Calgary would again get hit with golf ball-sized hail on July 24. And Alberta and Saskatchewan would be subject to the final round of impactful severe thunderstorms on the civic long weekend. In October, abnormally hot and humid conditions produced strong storms in Quebec, which had moderate-sized hail and damaging wind gusts to Montreal and surrounding areas. The final cat of the year occurred in southern Ontario and was a result of a November windstorm, gusts up to 141 kilometers an hour in Niagara, capped off the catastrophes in 2020. So it was a messy year. In addition to cats, there were also a dozen notable events. These are events that are not considered cats by CatIQ, but are smaller, at 10 to 25 million in size. So there were a bunch of these in 2020 as well. And you can look at the cat history here over the years. The red represents cat loss. We have added the LAE, the allocated loss adjustment expenses, in gray. I don't know if you can see it. And other notable events are in blue, the smaller kitty cats. Since the CatIQ database began in 2008, we have seen a steady increase in the annual catastrophe loss trend. And you can see that the norm now is $2 billion a year and not the $1 billion that it used to be. So we're cracking the $2 billion mark more regularly. You can see the Fort McMurray 2016 year. At the top, you can see the number of cats in red and the number of notable events in blue. So let's look at 2021 so far. Like I said, the first half of the year was quieter, but there were some events. So on Tuesday, January 12th, a low pressure system moving in from the Pacific brought strong winds to southern British Columbia. The system went on to feed another low center that was developing east of the Rockies, generating intense winds that swept through the southern Alberta, Saskatchewan on January 13 and 14. Southern Alberta and Saskatchewan saw widespread wind gusts above 100 kilometers an hour on the 13th and 14th, and some all-time January wind speed records were broken. Saskatoon Airport reported gusts of 102 kilometers an hour, and Regina reported a gust of 126. 100,000 customers without power in Saskatchewan alone. Extensive property damage to roofs, farm structures, and some commercial properties in Regina and Saskatchewan. $110 million in loss from that event to the industry. The Edmonton Squall on Tuesday, January 19th, just a week after the previous storm, another strong low swept out of northern BC and brought strong winds to central Alberta and central and southern Saskatchewan. This event was very similar to the previous one. The Edmonton area bore the brunt of the strong wind gusts, this time with wind gusts hitting 107 kilometers an hour on the evening of the 19th. The cost of this storm was $30 million to the industry. Between March 26 and March 29, a system from the US brought heavy rain and strong winds to most of eastern Canada. Unusually mild temperatures for Ontario and Quebec meant loss of snowmelt and localized flooding. The loss from this event was $44 million. Now we're into the second half of the year, basically, even though it was June 30th, I consider it second half of the year. We had the devastating and tragic Lytton wildfire. A record-shattering heat wave raged in BC and Pacific Northwest through mid-June. Lytton set and reset the record for all-time hottest temperatures in Canada. Tuesday, June 29, hit 49.6 degrees Celsius. Extremely dry conditions and the intense heat left conditions primed for explosive wildfire action. The fire ignited likely in town on the afternoon of June 30th. Village residents reported less than 15 minutes before the first report of the fire in town and when many structures were engulfed. The fire was finally declared under control on Sunday, September 5, though the remains of the village itself remained under evacuation order. The loss from this event was over $80 million. A series of strong thunderstorms rolled through Calgary on July 2nd. Hail up to golf ball size pelted the southern tier of the city, while torrential rain caused extensive road flooding and snarled traffic. Hail did damage to cars and siding of homes. Sewer backups were reported in basements and residential buildings. This event cracked $500 million on its own. The Barrie tornado happened on July 15. EF2 strength tornadoes, there were 6 of them, 6 EF2 strength tornadoes over southern Ontario on July 15th. The tornado that struck the south side of Barrie had winds of up to 210 kilometers an hour and caused extensive damage. At least 150 homes were significantly damaged. The cost of this event was over $75 million, sorry. A low-pressure system sparked 2 days of strong thunderstorms from Alberta to Manitoba between July 22 and 23. Hail up to tennis ball size fell in parts of east central Saskatchewan near Foam Lake and Okla. Very strong wind gusts also did damage, including in Regina, and caused a delayed opening for the Queen City Rib Fest by a day. $56 million of losses to the industry at last count. And then the White Rock Lake wildfire happened on, so I guess discovered near Merritt on July 13th and finally considered under control as of September 2. The fire burned through more than 83,000 hectares. It did extensive damage in communities southeast of Kelowna, including Monte Lake, August 5th, Killenny Beach, and Ewing's Landing, August 15. The estimate from this event is out, but I don't have it handy right now, but it's out. And the last one so far is the Alberta and Saskatchewan severe storms. Storms kicked off early August 31, pelting Assiniboia, Saskatchewan, with large hail and causing some damage to cars and things like patio furniture. Numerous large hail makers developed through the day, one of the largest moving through northwest Regina. Flash flooding and power outages happened. Also, large amounts of mostly smaller hail in Alberta, though large hail did do damage in Airdrie. The initial estimate is also public, but I don't have it here at the moment, I'm sorry. So if we look at the contributors to the cat load in Canada by province, we see that Alberta is taking the lead held for so many years. Before the spring of flooding and wind events in 2017, 2019, Ontario, Quebec. Saskatchewan started off the year dominating this year. However, the summer hailstorms in Alberta helped Alberta take the lead. This chart does not include the White Rock Lake wildfire and the Saskatchewan events from August 31, so it needs to be adjusted. The last slide in this section, and I'm not an expert on this, but the Intergovernmental Panel on Climate Change issued its last report in the summer, and basically declaring that human-influenced climate change is already affecting many weather and climate extremes in every region across the globe. Many changes due to past and future greenhouse gases are irreversible for centuries to millennia, especially changes in the ocean, ice sheets, and global sea level. So they highlight heavy precipitation and frequency of events, river floods, fire, sea level rise, urban warming, intensification of tropical cyclones, and extratropical cyclones, frequency and intensity of heat extremes, and agricultural and ecological droughts. We're already seeing increases in these extremes with every additional increment of global warming, and the changes in extremes become larger. So basically, we have to adapt and face this new reality in terms of climate risk as an industry. So COVID has accelerated digital adoption. So as many of you know, distribution winners are those that best adopt tech. And agility, adaptability, and resilience and tech adoption are increasingly table stakes. Other than protection gap lines, such as life insurance, earthquake, and cyber, such lines where we haven't got the full market covered, the rest is a zero-sum game. You're basically stealing business from other brokers, or carriers are stealing business from other carriers in terms of property and auto and commercial insurance as well. To those with scale go the spoils. COVID killed off kitchen table renewals. Brokers are increasingly challenged to outmaneuver direct digital channels to retain non-high net worth personal line business. Other phenomenon, consolidation and distribution set to continue, driven by scale and tech. And every distribution channel needs better shelf space with the carriers. A risk to that is reintermediation via MGAs. So it's a phenomenon of the hard market where your direct link to the carriers as a broker is kind of intermediated by MGAs, which could be a good or not so good thing. And then there's new tech entrants and threats, such as the large, I guess what we call the vertical, the full stack insurtechs, such as Lemonade and others that could potentially come to Canada that are full stack. Basically, they do the underwriting, they do the distribution, they do everything, and threaten both the carriers and the distribution channels. Other threats could be embedded insurance, where automakers, for instance, OnStar, throw in coverage with the car, subscription policies on the automobile, and so on. So there's threats from different directions that are on the horizon. And that's essentially it. I'm open now for questions, Q&A, and discussion.
We're just going to jump into some questions, and the first one we have here is from Marco. So how does Canada compare globally in terms of being attractive to capacity and investments into the insurance sector?
I think it depends on the lines of business you're looking at. Certain lines are attractive and certain lines are not attractive. So the question I've had perennially with Canada is why Geico and Progressive, those kind of companies, are not coming into Canada. And the answer, and the advertising those companies do on TV in the US spills over to Canada. Everybody knows about them. Everybody knows Flow. It's just the lousy results in Canada. That's kind of a protection we have. It's a moat of lousy returns on auto and property in Canada. There's been a moat to protect the Canadian industry from those sort of carriers. You do see, and I guess entrance into Canada is not impossible. You can have new companies come in as branches or as in partnership with other carriers as fronting arrangements and so on. I think it depends on the line of business. It depends on the environment. And I think the risk of having sustained excellent results is that you may wake up some of those sleeping giants.
Yeah, as I say, once they see that there's money here, they'll come take it, right?
Yeah.
One thing I wanted to ask is a lot of the presentation, and I've seen several kind of my years of going to different conferences, is always about catastrophic losses, major weather events. I was just curious, is there anything that like insurance carriers are doing to kind of fight back? I mean, the obvious elephant in the room for that presentation is global warming, right? And changes in weather. Is there anything that insurance companies are doing to kind of fight that and protect themselves going forward in the future?
Well, they're trying to find a pool for flooding to allow those with the highest risk policies. The IBC and others are working on that to find a way to provide flood insurance to all Canadians, despite the risk. There are areas in Canada that are uninsurable by the regular market in terms of flood. The carriers are wary of cases where communities are built back on floodplains. And you're going to see less and less appetite for those sort of things.
I can tell you right where I'm standing now, flooded multiple times. So
yes. So the patience will run out eventually, and the reinsurance capacity will run out for these sort of events if mitigation is not taken seriously. That's it. I think the other right now there is capacity, but flood is the highest risk of industry walking away from. Fire could be another one. You can look at California to see what's happening there. It's not unimaginable that we could have much bigger fires than we had in the Fort McMurray in Canada.
Yeah, I think I was here during the Fort Mac fire too, and that was couldn't even go outside even in Calgary because it was too smoky out. So I was just curious. At least I hear a lot of talk about always ESG scores and large groups like the insurance companies maybe not investing in companies anymore, or buying stocks and bonds that don't have kind of like a ESG rating or environmentally conscious, I guess, companies to invest in. Have you found, does that have any impact on the customer, like the purchasing decision? Am I more likely to go with an Intact or an Aviva or an Echo, knowing that they are investing in companies that are bringing about kind of green opportunities and change?
I haven't seen evidence of that. It's more likely to have an impact on direct writers doing that because they communicate more directly with the consumer. Desjardins, other companies like that, TD. The consumer is aware of these things, and I think if carriers use that as a marketing tool, or IBC uses that, it will help the image of the industry. And
I was going to say, any of the carriers on the line, that's like a missed opportunity, I think, in just how you promoting the brand, right? Where do you spend your money on?
Yeah.
We got another question coming in, and again, feel free to ask any question in the chat, and we'll try and get to all of them. In general, what has been happening to the frequency and severity of losses over the past 18 months?
Depends on line of business. So
I think we've got a lot of commercial brokers on the. So I guess kind of like in the commercial, from a commercial aspect, what's kind of the biggest?
It looks like the activity has slowed down in the first half of 2021. It could be that there's reserve releases. It could be that there's less activity, less claims, less action with the lockdowns. I think it's kind of a lull right now. But it's also the hard market is buffering any claims that are coming through.
Yeah.
So.
My question I always like to ask whenever I have someone who's kind of big into research is, where do you go to get your information? So for the average broker on the call, what are some places they can subscribe to, or information sources they can kind of keep a lookout for to learn some of this information?
MSA, to the man horn, MSA is the provider of financial information to the Canadian market. So brokers, quite a few brokers do subscribe to MSA, and you can, if you're interested in getting access to the same data that the carriers have, the reinsurers have, the reinsurance brokers have, the IBC has, and everybody has. It's not prohibitive. If you're interested in getting access to that platform, and you have a young whippersnapper that can manage the platform and run queries for you and run data and kick out reports for you, we're happy to talk to you and get and onboard you. with the data. So you'd have all the data going back 10 years or more on the financials and get updates every quarter.
Okay, that's good to know.
Mhm.
And then our next question from a former Amplify presenter himself, Nick Roper. So the U.S. seems to be more inclined to bring in government-backed programs. Do you have any info or comments on the possibility of Canada doing the same at a large scale, like risks just like the pandemic here?
Well, IBC is working with Public Safety Canada on a flood solution for Canada, which would require government backstop. There's no official backstop other than that in the works. The only backstop the industry has right now is PASIC, which is the industry compensation fund, which comes into play if a carrier goes insolvent. Then the PASIC would compensate the policyholders. But the government is not backing any carrier at this point. But we think the flood would be the first one, and then earthquake could be a second one. Pandemic is so big that I don't think governments would officially back the industry on that. I don't think the industry has got appetite to underwrite pandemic in the future.